Do want to have a more broad conversation as we do have a potentially very big week in the markets this week. Want to welcome in Ted Thatcher, president of Bright Lake Wealth Management, joining us this morning. Ted, happy Monday to you. It's Fed week. We've got Mag 7 earnings, a slew of other big companies reporting this week. As far as your outlook for the week on the whole, what are you expecting here?
Marley, right now, when we look at the markets, I actually think volatility is the name of the game. We're coming at the end of the month here, rounding the corner into February, and we are having conversations about what the Fed's going to do. It doesn't look like we're going to get that rate cut. We're having discussions about a potential trade tension, and even trade war has been thrown around with Canada. We're talking about the potential of a looming, government shutdown again, and a little bit of discussion, of course, around the political unrest in Minnesota. And so it echoes a lot of what I think we saw in 2025, Q1 and Q2, of course, underscored and underlined with everything that happened with the tariffs. And so it's a little bit unfortunate. I think the market, all it wants right now is stability and consistency. And while we do see a lot of positive economic data points and vital signs, in my opinion, it just doesn't seem that the market can hold on to those because of all the questions it's having to ask.
Yeah, and we do have so much uncertainty, a lot of it headline driven with some of these geopolitical risks that you cited here. But you also mentioned that we are getting some stronger data. We've got GDP seemingly strong. Inflation appears to be cooling here. But we're also still hearing consistently that many Americans still feel very stuck right now. Where is that disconnect, Ted?
It's a really, really important question for consumers to be asking. We do see a lot of positive economic data points. You mentioned GDP, you mentioned inflation, even consumer sentiment and consumer confidence are trending up, but again, not enough to your point. And so, so much of, the broader economy has to have a conversation when it comes to the consumer. And so when we think about where the consumer is at right now, I think we have to move from a conversation about a stimulatory access to the economy to a more durable one. We see the big, beautiful bill having been passed. We expect that to put real dollars in the hands of consumers. That's a positive stimulatory effect. Even if we look back a few weeks, we saw the government, looking to buy $200 billion worth of mortgages, stimulatory access to the housing market. But that is not going to be enough until we get a more durable access to the credit markets for the consumer. There's going to be a conversation about whether or not the consumer is benefiting and whether or not the economy is working for all Americans.
So how does that work in theory? If we're breaking this down in plain English, if we need to move from stimulatory, which I think is one of those things that actually increases sentiment in terms of asking people if they feel more or less stuck right now, to something that's more durable, what specifically are you watching here? Is it the housing market? Is it the credit market? Is it the labor market? Is it all of those things? And what do we have to see to indicate an actual durable American dream versus one that's just like a sugar high stimulus?
Absolutely. I mean, I do think it does come down to the credit markets. So, we have had such a big discussion about deficit spending and GDP growth versus, how much pressure is being put on the debt markets, right? So much of the governmental institutional money flows have been seeking that flight to safety, right, toward the precious metals instead of government treasuries. And so what I think we need to see for that durability to really come into view, Marley, is actually a shift there. We've seen real positive GDP numbers. We need to see that continue in Q1 and Q2 and throughout 2026. Why? Because this key measure of the GDP compared to our deficit needs to shrink. As that shrinks, the credit markets will also become cheaper, giving consumers more access. So if there's a real specific data point, that is what I'm looking for. Now, again, we do have a lot of other positive economic data points. You even brought up, the earnings that we are going to see this week. As we went through Q4 and what we anticipate here in Q1 is a lot of good earnings. So if we can pair those, macroeconomic vital signs with really good durable earnings, I think that's going to be really positive for the markets this year.
All right, so let's stay focused in equities here for a second, because I know you see some opportunities here, despite there being uncertainty similar to Q1 of 25. You still see some investment opportunities here. Where do they lie? Are any of them in these companies reporting this week, or are they outside of that window?
Of course, there's always a fun conversation to be had around the Mag 7, and we'll come to that. But when I look at opportunities, when I'm talking with investors, we are thinking about the tailwinds a lot of times in the AI economy. And when I look for opportunities, what I typically think about is, okay, what are the bottlenecks? And one name really does stick out to me here as a potential grower, and that is IREN, IREN, ticker symbol. They were a Bitcoin mining company that really transitioned into this AI economy to become an AI cloud and compute company that is vertically integrated, most importantly, with secured access to energy and electrons. Energy, electricity, electrons are the key bottleneck in the AI economy right now, and IREN is really positioned well to take advantage of it. They've just penned a nearly $10 billion deal with Microsoft, $2 billion of which would provide it up front, and that only sold off about 10% of their secured access and arranged power. And so there's already rumors about other hyperscalers, being in the mix with them. We'll see what happens, but I think that is one equity name that's really in a nice position.
And Ted, since we are kicking off Mag 7 earnings, I do have to ask, if you have a pick in the Mag 7, who would it be?
Sure. When I look at the Mag 7 right now, Amazon does stick out to me. Now, I really like where it's positioned from a price to earnings ratio standpoint at 33. It looks like a cheap buy just by the pure numbers, but also where they sit in the AI economy. Amazon's value has been driven a lot in the last several years by its AWS cloud services. And so, of course, just their AI compute side could drive a lot of growth. But what's really interesting to me is really where Amazon has come to in the way that most of us consumers interact with it. And that is, of course, the boxes that show up at our doors every day. And so the logistical side of Amazon has another huge room to grow. They are the king of robots. I think that they now have over 1 million robots. And they are, I think, the first major company to maybe able to hit that singularity of more robot employees in AI robotics versus actual employees, which could drive a lot of growth this year as well.
Well, Ted, it's always a pleasure to speak to you. Thank you for being with us and for that insight this morning. Ted Thatcher, president at Bright Lake Wealth Management.